Good morning. My name is Campbell McCrary. I'm a Vice President of Capital Markets at AM EST Capital in New York. Welcome to the AM EST Capital live webinar with SilverCrest Metals Inc. SilverCrest trades on the TSX as SIL and on the NYSE American as SILV. Hope you'll enjoy today's program. It will also be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel or simply email them in. We'll try and get to the questions in real time. AM EST Capital is a New York-based specialist investment management company and corporate finance firm focused solely on the natural resources sector. Please note this call is for informational purposes only. We're very pleased to have with us Chris Ritchie, making you presenter, Chris. Chris is the president and has a he's a financial markets professional with over 15 years of experience in resource-based capital markets, including investment banking, marketing, corporate strategy, network, and risk management. And during the past 8 years, Chris, through National Bank Financial and Canaccord Genuity, has been a key financial advisor and partner to the previous and current SilverCrest teams through the development of Santa Elena, the sale of SilverCrest mines to First Majestic Silver Corp, and the 3 financings for SilverCrest Metals. This relationship provides strong continuity in his role at SilverCrest. Again, following the formal presentation, members of AM EST Capital will ask questions of Chris, and we also look forward to any questions that are sent in. Just use the chat feature there in GoToWebinar or dig up my email and the reminders, and we'll get to those that way. So Chris, if you want to do your slideshow in from beginning slideshow mode, we'll get started.
Right. Let me just see if I can.
So left corner there from beginning, just click on that. Top.
I'll just do that one. I'll do it from the current slide. Thanks everybody. I hope everyone's having a good Friday and you're in a little bit warmer, sunnier places than snowy Toronto. Want to always start here just giving people a bit of overview of where we're at. Lots happened. We just had the election. You know, COVID second wave is kicking in. Saw a really interesting new data point that is not in this slide, but 21% of all US dollars ever printed were printed in 2020. So again, we're in a very, very interesting world right now. In Canada, again, we just increased our stimulus pretty aggressively. I heard $7 have been spent on stimulus for every $1 that's been lost in the recent COVID sort of economic hardships. So again, very interesting time in terms of where we're at. So the first chart here, again, people have seen this before, I'm sure, just how big and strong this bull market has been in everything else. And again, there's an acronym in the US called TINA. There is no alternative. So part of the inflationary trade is money is making its way into traditional stocks. But again, some of that has not really made its way to the hard asset space yet. This chart is the inverse. Goldman Sachs commodity index. So it's, again, a basket of commodities versus the broader market. So again, commodities have not been this cheap in the last 50 years or so. And if you take that same Goldman Sachs commodity index versus the Dow, it hasn't been this cheap in 120 years. So again, this chart's as of sort of August range. But again, the market's only gotten stronger and commodities have started to sort of rebound a little bit, but just worth noting. Again, just showing how divergent the broader market is versus cyclical stocks. So again, the backdrop here is just getting better and better. This again, active to passive, just again, follow the herd type investing, lower fees. So again, all showing that money's been unilaterally going in one direction for quite some time. So it's just getting a sense of what sort of might change things a little bit. This chart, again, just really talks about that fund flow shift that might or might not happen. So what it is looking different. Inflation numbers that have been present in the market for over a long period of time. So again, since 1920, so 100 years. And the dot represents just, again, the number of times that inflation rate has taken place relative to the multiples on stocks. So again, the higher, the multiple range is in that 21, 22 times range is in the inflation bucket that we're in today. So again, multiples have not been higher. Market has not had this big of a run ever. Divergence between stocks and commodities haven't been this wide in over 100 years. And one of the other charts we'll try to show here is just like how small the hard asset space is. This one's in particular to golds, but if you take a gold ETF, it's still less than half of 1% of worldwide funds. If I was to put this slightly differently, for about $5 billion, you could buy up 20% of the annual silver supply. So again, does not take much money to really change the values in the gold and silver, really drive pricing here. So again, we're on a really interesting precipice here. Here, just showing velocity. Everyone gets a sense of that. I mean, more and more money's out there, but velocity is coming way, way down. If we get that velocity starting to tick up, that's probably one of the biggest drivers of inflation here. And again, there's the printing. So we're in this really, really interesting time. And again, aligning that with what's going on with COVID. And a lot of this took place since 2008, not necessarily just 2020. So here's a chart again, just showing how gold has performed relative to negative rates. And again, the gray bars are showing the periods over the last 50 years where we've had negative rates, and gold has responded quite sharply. So again, on the far right here, just showing 2020 with rates being where they are, not nearly as negative as they have been before. And gold really starting to move. So if you do see that more printing, negative rates, lower for longer, again, there's still plenty of room to run here. The quote on the top of this page is probably our favorite as it relates to this particular theme. We're not thinking about raising rates. We're not even thinking about raising rates. So the backdrop is quite interesting. It definitely relates to SilverCrest in the sense that I don't know if gold's going to take a bit of a breather here with the vaccine, or it really doesn't stop anything to do with the printing that's going on. But this chart shows the relationship between money creation and gold. And we're definitely seeing more money creation. And whether you were in the Republican camp or the Democrat camp, if we take the money printing away and the stimulus away, every time we've kind of looked at that, it's been markets rolled over. The government's had to step in. So we either keep going down this trade, or the market's in big trouble because we don't have that stimulus to hold it in, which might, again, stimulate more move towards the risk off trade, which would be gold. This one and this one, just getting a sense of how big the bull markets can be. I mean, the circle in the bottom left just gives you a sense that, silver's had a nice little move here. But again, if you relate it to other bull markets in silver, we're in inning one. And that's a big driver for us in just terms of getting a sense that we're just getting set up here for an interesting trade. The ESG, just really briefly, the number one area of AUM, so that's assets under management, of number one view of AUM is on the ESG side. So again, that's environment, social, and governance. So again, big on the environment with solar power, because silver is a huge contributor. We've been in our community for 16 years, huge COVID response. But again, you are seeing a big growth drive that way. So again, ESG is way up our list in terms of important things here. This is the last chart I'll show, and then we'll get into the presentation a little bit. But one of the key components of SilverCrest is our high grade allows for us, or should allow for us, to have really strong margins. So again, we are not in production, but on paper, and again, this is based on our oldest academic economic study, we had a cost, and this is a total cost, to pull silver out of the ground at about $5 per ounce. And as you can see from the dotted red bar on the left, that puts us in the 7th, 8th percentile of all companies out there. So again, that ties in quite nicely with, we don't know when things are going to turn or if they're going to turn, if we're 3-4 more years before the cyclical stocks really get control here, or get their moment to shine. But it's okay if it takes 3-4 years. Again, there's plenty of different vehicles you can choose to represent buying gold or silver or commodities. But the point is for us, we should have really strong margins all the way down into the $10, $12 range. And again, you can see from that turquoise blue line that goes kind of left to right there, looking at sort of the average all-in sustaining cost, people are not low cost. Again, if silver rolls over here, a lot of supply comes offline, and a lot of other investment vehicles get challenged. So again, we can afford to wait it out. So I'll kind of go back to SilverCrest, and I'm sure some people have heard the presentation before. A few key factors here. One is that we've done this before. The vein that we'll talk, or the mine that we'll talk about today, is in Sonora, Mexico. So it's northwest Mexico. Sorry for the jumping around there. It's 25 kilometers away from an existing mine that our CEO discovered. He built it. He built it on time, under budget. That's really important. And he operated it for 5 years. So here we are starting again, 25 kilometers away. We bought it for $4 million. We're here about to put out our upcoming feasibility study. That will be a new update of all the economics, additional capital we need. We'll be able to talk about the growth today, but we've done it before. So again, that's a big, big deal. Our COO built the largest gold mine in Canada. So again, that project was about 40 times the size of this one. So again, we've done this before. The base case IRR, and again, that study is about 18 months old. But if you look at the commodity prices shown, sub 17 silver and sub 1300 gold, we still had a payback of less than 1 year. Now, again, our capital is going to go up in the new upcoming study, probably by, in the range of $50 million. So that 78% will change, but the payback period still shouldn't be much different, especially if you look at today's commodity prices. The PEA only included 10 veins of 45. The upcoming feasibility study will include about 21 of 45. So still a lot of growth to be had. Of the 21, about 5 or 6 still have a lot of potential on them. And those are the lowest risk veins to drill, because you already know the ounces were there from what you found. And if you're just continuing along the same strike length, again, lower risk than starting from scratch. On top of that 45 veins, we've made a recent new discovery called El Muerto, and that's at a slightly deeper zone to all of the reserves and resources we found so far. And that opens up the potential, and I'll highlight the word potential, for that horizontal zone beneath the existing infrastructure to spread out across some, most, all, we don't know yet, of the other veins, to provide a wholly different target area that could apply to more veins. So again, if I was going to be really bullish, and don't take it this way, but maybe there's another 20, 30 horizontal veins below the existing veins at Las Chispas. Again, have not proven that out beyond the one vein, but does open up the potential pretty significantly for us. Also not included in those 45 veins is a brand new property we just bought. So this will be the third property we've bought in this area, and our CEO has taken the first one from about 4 million up to about $1 billion. This purchase was about 4 or 5 million, and we're about 1.2 billion US. So again, we spent $2.1 million on this asset. So again, pretty low risk, and hopefully that's something that turns into something much larger. The balance sheet today, about 130 million US. Again, I referenced needing more capital. We probably will need about 150 million additional, 150, 160 additional capital above and beyond the cash position. We are working on some debt. We will need a bit of equity, or we'll want some equity. But that should be something where, given our current share count of 129 million shares, the current share price around $9, $9.50, I don't know where we are today. Very, very minimal dilution if we were to looking at another 40, 50, 60 million of equity. The biggest part of our story has been the drilling leverage. And what we mean by that is, for every drill hole we put in the ground, if you're finding more gold and silver, adding value, that's been driving the share price pretty significantly. So again, if you look at the numbers here, you'll say 40% of drill hits above 350 grams per ton. If we had an average grade of 350 grams, we'd be a top 20 highest grade mine in the world. So again, we're averaging 40% above that level. Our average grade currently in the PEA from a year and a half ago was 723 grams a ton. So, double that. The discoveries we've made since then have a lot of them been above 2 kilos, 3 kilos. So again, the average should be inching up. And one thing that we have done for the upcoming feasibility study is increase the cutoff grade. And what that means is, you might have certain areas of the property with 200 grams per ton, 300 grams per ton, but if they're narrow and it's not economic to get, we're eliminating them from the study. So again, that's actually going to increase, or should increase, the average grade that we get. So again, nice trends hopefully coming our way. The efficient use of shareholder capital, I'm going to give our drilling team all the credit for that. Again, we've got about 150 we've spent so far, 150 million on a market cap of about 1.2. So if you think about what we've spent divided by market cap minus the cash, we've added about $7 for every dollar that we've spent. And that's really critical here in terms of us needing and wanting some more capital, because a big chunk of the capital that we're going to spend on the go forward basis is not just to build the project, which we will be starting in January. It's going to be to drill aggressively. Okay, so we have spent about $90 million in drilling, and we hope to spend about 60 or 70 million in drilling in the next 2 years. Now that 90 million I referenced, that's since we started the company in late 2015. So if you've kind of gotten to here based on that drill bit, we hope to be drilling 60, 70% of that quantum between now and getting to cash flow. So part of the story is, let's get to that cash flow story, and then hopefully we can grow the number of ounces at the same time. I've referenced this chart before, and this is a pretty big one, but again, this is 18 months old. But if you look in the top left, you'll see the commodity price used on the study. And if you kind of scroll down from there, you'll see that IRR and the payback periods and whatnot. The middle column here is what we'll spend a bit of time on. You'll see the average grade, and that's grams per ton. Now that's AGEQ, that's silver equivalent, or AUEQ, gold equivalent. So we're roughly 50-50. So for here, you'll see that in that old study, we would produce about 13.7 million ounces of silver equivalent per year. And just below that is the AISC, all-in sustaining cost, at sub $5. The feasibility study should be in and around the same area. Again, the average grades should be going up, but not necessarily in year one. Year one, we're going to be conservative and just ramp up slowly, make sure the mill's working properly. But still, if you look at that margin, if our costs hang in the $5, $6 range, again, we talked about that being in the bottom 10 percentile. If you wanted to assume 6, today's silver price, that's about $18 of margin. So again, if you take that 12 million ounces, 13, 14 million ounces, whatever number you want to look at, multiplied by that $18 margin range, you get a pretty healthy number, and take 25% off for tax. And you get an after-tax free cash flow yield, something in the mid-high teen range. And again, that's pretty significant in that even if we were to be more defensive, and let's take $15 silver. Remember we referenced with that all-in sustaining cost for the peer group, that that's getting close to break even. For us at the $15 silver range, we'd be in the range of somewhere between $8 and $10 of margin. So again, multiply that by 12, 13, 14 million ounces, and you're getting something in the range of 8 to 10% free cash flow, all when the rest of the peer group is close to break even. So again, the defensive part of our story is something we definitely want to highlight. The average grade and the production profile, I just want to highlight that number in 2022 there, that's going to change pretty significantly in our feasibility study. Year one in our feasibility study, again, we're going to start with some lower grade material and just inch it higher grades into the mill once we know it's working pretty well. So again, ramp up, get some confidence, make sure everything's working well, and then charge forward with the really high grade. Want to spend a bit of time on the financings just for people to get a sense. We've raised money 6 times in the last 3 years or so, and you can see from the chart on the top left, every time that we have the the performance after the deal has been quite strong. We reference needing more capital. The capital will be to finish building the mill. Working capital, make sure you can get out of the first few months that everything's working smoothly. Having a buffer, just a minimum cash balance on your balance sheet. 2 years of G&A and overhead and COVID-related costs. And then we also mentioned the aggressive drilling. But again, if it is 150, 160, final numbers are not complete. If we were to use 100, 120 of debt, you get a sense again from this slide that even at $19 silver and $14.50 gold, you could pay back that amount in less than a year. You know, at today's prices, and if the production profile is hanging in at these levels, quite a conservative amount of debt. And again, just to reference the shares outstanding on the top there, the 129, 8 million shares, 7 million shares, 9 million shares multiplied by the US share price today. Again, you're 5, 6, 7% dilution. So again, we've done the hard work with the share structure. So again, we're not sensitive to dilution, which is fantastic from a market risk perspective. Quickly on liquidity, we're really starting to see some big accounts able to look at us now. If you manage $3, $4, $5 billion, you need stocks that are trading $10 to $15 million a day at least before you can even consider them to be something in your portfolio. So as we grow, get to cash flow, if gold and silver go higher, there's a whole new audience that can start to take a peek at us. So again, that's hopefully gets easier and easier as you get to cash flow. Another really interesting data point is that we've traded about $1.6 million worth of our stock since June. And again, our US market cap's about 1.2. So in that time range, we told people we're going to have a feasibility study out either end of year or January. We're going to put it out in January. You know, we're going to need some more capital. We don't know what the exact numbers are going to look like. And a lot of people took profit. They said, great, let's, you know, rotate into something else that hasn't performed well yet. You know, we've made some money. Let's just kind of right size our position. So the point of saying this is just to give you a sense that we think we're pretty healthy. We think the expectations are reasonable, what we're trying to set for the upcoming study. People are aware that we need more capital. There's no surprises. And hopefully once we put that study out into the public domain and people get a chance to look at it and get a sense of what we're doing and charge forward, it's then going to get to that free cash flow in the back half of 2022. And hopefully, again, add more ounces with the money that we've allocated for the drill bit. So just a little bit more time on the drilling here. Again, if you look at the bottom right here, you get a sense that we've spent about 70 cents to find an ounce. If you look at the numbers just above that, you're getting a sense of the high grade that we've intercepted. You know, 550 intercepts over a kilo, 63 over 10 kilos. We made a recent discovery a few weeks ago in a brand new vein that will not be in our economic study. And the average on that discovery was 9 kilos. So again, you know, when we actually go into production, we're going to mine that material, not going to be incorporated in the study you see coming up. So again, we might have a big number of resources that are not in reserves. And what that means is they're not incorporated into the mine plan. So when you see that number come out in the upcoming study, you can get a sense of, oh, X number of ounces. I think they're going to be able to convert some, most, all of these into another updated study next year. And then people can get a feel for how much further growth. A quick example of some of that hopefully low-hanging fruit growth is that bullet point number 3. Bobby Vista is a vein that we think is comfortably over 2 kilos, and again, the average grade is over 700, so it can have a significant impact. Now we've only drilled about 40% of that vein, so we anticipate, and again we'll see, but we anticipate that we'll be able to drill the rest of that vein in 2021. So again, if we find more there and we're able to infill that, put it in a mine plan, move those ounces earlier into the production profile, could have a really nice impact in terms of that ounces per year, dropping the costs and increasing that free cash flow. El Picacho, a new property. And this goes back to the scale potential and hopefully the low cost scale potential that we really try to focus in on. That's the property I referenced earlier. We spent $2.1 million. It's 85 kilometers away. That is within trucking distance. So if we're able to find some more tons here, and we don't know the grade obviously, if we're able to find some tons, ship them over to our current area, put them into the mill, we're either increasing the mine life or we can potentially increase the size of the mill. So all those production profile numbers we referenced earlier, 12, 13, 14 million ounce per year, that assumed a 1,250 ton per day mill scenario. We are permitted for 3,000 tons per day. We do not have the tons currently to justify using that. But just to save you some quick math, if we were to find 2 million tons at Picacho, and again, yet to be seen, that equates to 500 tons per day for 10 years. So if we can go from 1,250 tons a day to 1,750, that has the potential to increase our production profile. But again, it just depends on what we might or might not find. We believe, and again, we haven't done this work completely yet, but we think that for about $30 million of capital, we can make the adjustments to the mill to allow for that increased capacity. Again, all things we're working on, not in hand, but it gives you a sense of the low cost option value. So let's say it was 1 or 2 or 3 million additional ounces per year at these sorts of margin, you get a feel for what the free cash flow yield could look like. So I think the bottom line for a lot of people is to get a sense of is we have most of our money in hand. The capital that we still need is pretty small relative to where we're at. The detailed engineering is well underway. We're probably going to be about 40 or 50% complete by the time we release the study, which is well above average. We have a team that's done it before, and we're still really in the early days of growth. So we're still in growth mode as we still push really hard to get to that free cash flow mode. So pretty high level there. I think it's probably time to take some questions if anybody has any.
Let's join in, guys, and we'll throw some questions at you. So we've got quite a few. Let's start with just Mexico, and currently the president wants to raise taxes on resource companies. Can you talk again about the current tax rate and how would a proposed 30% tax affect you, and maybe just bring us up to date on that subject?
Sure. I mean, I've said this before, and people might have heard this. I don't want to equate logic and politics, but you'd like to think that resource companies, if the commodity prices are doing better, further investment should be the priority in terms of just encouraging people to spend more. I'll go back to the all-in sustaining cost. if there's any increase in tax, the people who have higher costs have lower margins. They're going to be more impacted by that. So, for us to have another 5% tax, we're not gonna like it. But again, it just shows our value versus our peer group at that time. If the average silver producer is somewhere between $12 and $15 per ounce, and silver rolls over, and you've got higher taxes, the downside risk on our peer group is much greater than ours if we can execute at the cost we think we can.
Do you think the updated economic study will add ounces to yearly production after year 4? So we don't see a production decrease after year 4?
Yeah, I mean, the idea for the updated study, obviously having a higher degree of confidence in all of the inputs, probably to smooth out the production profile a little bit. We've been drilling significantly since May of 19, so to be able to add some ounces. And again, for us to fill the mill, we need roughly 450,000 tons. So every 450,000 tons is another year of mine life. So I referenced how much growth potential is still there. When you do infill drilling, traditionally you lose some ounces in tons, but the confidence goes up. We have a good chance of losing some tons, but people can make a guess whether or not they think the ounces went up. So if you have fewer tons, but similar size number of ounces or maybe more, you have less cost to develop the underground, right? You have more margin per ton, more production per ton. So we're getting more efficient, we're getting more economic. And if we found 85 to 95 million reserve ounces in the last 5 years, and again, year 1 we only had 1 drill rig. By the time you get to year 6, 7, 8, we will have more than doubled, probably tripled the amount of drilling we've done on the property. So I come back to the fact that we're still very much in the early days of learning what this property has. So yeah, I can't really get into details on the economic study, but we've made a lot of progress since the last one.
Okay. You indicate 40% of drill hits above 350 grams per ton silver equivalents, including all drill efforts, whether hits or not. Do you have an average grams per ton silver equivalent?
Yep, in the May 2019, and I can only reference that because it's the last publicly published document, it was 723 grams per ton. I referenced changing our cutoff grade and to a higher level. So that means some of the lower grade tons and ounces are being excluded. So that gives you a sense on how the average should move. And some of our discoveries, or most of our discoveries since May of 19, have been at higher grade. So again, I can't get into the specifics, but hopefully you'll get a sense of which direction it's going in.
Again,
I'll just also clarify, that new discovery we made a few weeks ago won't be in the mine plan. And again, it was something that had a small area, a little over 1,000 tons, that probably had $30 to $40 million of value in it.
Yeah.
So that would be 1 day's worth of mining that could contain, $30 to $40 million of value. So it gives you a sense if we can then put that in the mine plan, before we get going, which we will. It gets you a sense of pulling forward that cash flow and what it does to the margins.
Okay, thanks. Stu?
Yeah, thanks for the presentation, Chris. You touched on ESG before. On the ground and at the project, how are you approaching ESG? I know for some people it's a bit of a buzzword at the moment, but what does that mean to you guys at the project level?
The biggest thing it means to us is being in the community. You can either be in the community or you can be above it. You can speak to it with a suit and tie and fly in and fly out. We've been in the community for 16 years. Eric and Rosie and Nathan. Rosie and Nathan are Eric's kids. They've lived down there except for COVID for probably about 6 years now. It's a ranching community. We have our own cattle ranch, so we're in it. The programs we're doing now. We have a meeting this morning. I was on with the government program to look at rehabilitating the water treatment plants. They don't have sewage in a lot of these areas, protecting the agriculture for the water side. We've finished a full materiality assessment to go through all of our material risks from the environmental level, social level, people level, corporate governance level, business resilience, putting that into a full formal action plan to be down there. Our budget's increasing as it relates to being there to support. COVID response was a very, very big part of 2020. Giving medical supplies, testing all of our employees, building a full camp where everyone has their own isolated area to live in with no recirculating air. Probably spent about $12 to $15 million on COVID-related safety for our employees. For us, if people don't want you in the community and you're not a good participant in the community, you're not going to be there. So again, for us, it's second nature. But again, it's a really big thing to make sure that you're respecting and helping out the communities you're living in.
Fair enough, thanks. And you mentioned the recent discovery at the Vista vein. How often are you guys thinking you'll incorporate exploration success into an updated mine plan?
So here's the strategy. We've always tried to quote unquote drill ourselves cheap. Meaning, oh, you're expensive, and then we find a bunch more ounces, and people kind of put that into their valuation work, and we've kind of been able so far to sort of keep that train rolling. In the first half of 2022, so 14, 15, 16 months from now, we intend to put out another updated reserve and resource report and an updated mine plan. So to give you a sense, again, we're going to have a certain number of ounces that are in reserves, and we're going to have a certain number in resources. Part of our goal in the next 15, 16 months is to convert some or all of those resource ounces into reserves and put them into the mine plan. So again, we've been guiding people 85 to 95 million reserve ounces. If people assume that we can find 10, 20, 30, 40 million more reserve ounces, and who knows, that's just to say, that goes into your NAV. But if those ounces are higher grade than some of the ounces you're currently contemplating, you can pull those forward sooner if the infrastructure allows, and you can make positive adjustments to the mine plan. And the reason we want to do that in H1 2022 is we hope to be ramping up production in Q3 2022. So if we've shown that our value's grown, and that's an if we can optimize that mine plan and get more grade earlier, increase the production profile, it makes that potential re-rate even more robust. So again, if we are producing 12, 13, 14 million ounces per year, we'll see, who knows? $5, $6, $7 costs, who knows? You get a sense of where that margin profile goes. But if you can inch those ounces up, 500,000, 2 million ounces a year, makes a really big difference. So again, we really want to highlight to people, if gold and silver roll over, taxes go higher, the vaccine comes in and everyone thinks that money printing will stop, we should be one of the last men standing in terms of this mine. But if printing still goes, commodities go higher, we find more ounces, we keep de-risking the property, there's far more ways in which we can re-rate to the upside, and we can have all the patience in the world to get there.
Yeah, gotcha. Thanks for that, Gabe.
Thanks. Hey, Chris, the last time you were on, you mentioned Vista, you think that's going to come into the mine plan. Is that something that you expect to come in sort of in the earlier years, or when, if that proves out?
Yeah, so some of Vista will be in the upcoming mine plan. But I referenced here only 800 meters of 2 kilometers have been drilled, and then we hope to drill the other 1.2 kilometers in the upcoming year. So yeah, we hope to have those 800 meters worth of ounces in the mine plan, and then we'll see if we find more on that vein. But again, should be lower risk given that it's just extensions of a current existing positive vein. It's the nearest vein we have to surface.
Okay.
So infrastructure wise, and this is a big thing on mining, if we found a brand new vein and we started to go to a different part of the property to drill it off, that's great. But we'd have to go spend a lot of money to build the infrastructure to access those ounces. The cheapest ounces we can find are the ones around the existing infrastructure that are incorporated into the capital number we've outlined, or we've at least highlighted. So if we can find extension of veins with new ounces, they're by far the biggest margin ounces we can have. So everything that we're going to be focused on is on just walking out on veins where we've already had success, and that updated early 2022 game plan will be to optimize everything we possibly can with that mine plan. So again, move that high grade forward, bring that cash flow up. Really, hopefully, we can revamp the re-rate that that most companies get when they enter cash flow.
Yeah, that's great. And in terms of the sort of the studies, are you going to go from PEA straight to feasibility, or is there something in between? Yeah.
No, right to fees. And I mean, if you're going to find the silver lining of COVID, pardon the pun, everything's been slowed down except for our detailed engineering. Engineering work has been going on pretty aggressively. Normally, when you have a feasibility study out, you're somewhere between 10 and 20% of your detailed engineering complete. We're going to be in the neighborhood of 50%. And this is also where we come back to the fact that this is a really small mill. The underground development's been going for a year. We're already started the earthworks. We built the mine next door. So again, we were very comfortable going right from a PEA to feasibility study because the work we've done has sort of eclipsed what would be normally done on a feasibility study.
Got it. That's great. Is there an upper limit to the grade that the mill can handle efficiently?
Yeah, I mean, we didn't get into that today, but you know, we talked about 100 million of capital in the PEA, and the capital is going to be, you know, I referenced 140, 160 range. Power line, some COVID. The third change of why the capital is higher is because of adjustments we've made to hopefully handle that higher grade. So again, for people who aren't aware, silver recovers differently at different grades based on different processes. So you've got to get the right recipe here for what type of mill design you have so that you can handle high grade. So again, going back to the fact that we've been underground for a year, we can test the ore, we can do all our recovery work with actual ore, not just, you know, studies. And we've done our best. We think we can. I mean, time will tell, but we think we can handle the higher grade based on the design that we've put in place.
Okay, thank you. That's all from me. Artie?
Thank you, Chris. In case of like a higher production rate scenario, how are your vein dimensions, and are they like potentially makes you able to exploit higher tons? And what type of mining methods are suitable?
Yeah, so most of our veins here are fairly narrow. Our main ore body, the Bobby Kenora main area, is probably about 3 meters wide. You know, there might be a combination of long hole and cut and fill there. Hopefully a little bit more long hole. Most of the other veins are somewhere between 0.8 and 1.5 meters wide. So more cut and fill, higher cost, more dilution. So the key here for people to get their heads wrapped around, we need a lot of underground development to make sure we have enough stopes available so that we can deliver a consistent amount of tonnage to the mill on a daily basis. So when we do find, or if and when we find more, have more success at Bobby Vista, for example, the productivity per vein might not be a lot. So it's not as if all of a sudden you're going to 50% of your throughput is going to be from that area. You know, it might be 5, 10, 15%. So I mean, you're optimizing continually. So that also, again, goes back to finding ounces around infrastructure is quite critical. So that the mining method, I answered those question. What was the other part of the question there, Ari?
And do you think these like vein dimensions would allow you to like practice different underground mining methods for high production?
Yeah, we are, right? I mean, that we've been underground for almost a year, so our confidence is growing by the day. We will have hopefully about 6 months worth of ore sitting on the ground by the time we start the mill. So again, from a risk perspective, we're testing out those models and whatnot and doing a lot of work ahead. But it does go back to, we built the one next door. Ground conditions are very similar, so a lot of experience so far. On the tonnage side, again, this is low ton, high grade. And again, you actually want low tons. It sounds a little counterintuitive, but it's less development and less cost to mine. So it's all about the grade per ton. And again, for us, you know, we've got only 21 of 45 veins plus the deeper zone in the new property. You know, about maybe 7-8 years of mine life currently, with a lot more drilling to do. The new property is totally different. A lot of sort of, you know, head scratching work done, not drilling. But we think those veins are a lot wider, and there is actually the potential for some open pit targets there. Now, if that's the case, again, your mine life can go way up. There's the chance to increase the throughput. Just all depends if we have any success, and if so, at what grade.
Thank you. And how your recovery numbers has changed since the beginning?
The recovery numbers for the feasibility study since the PEA have been released. That's public information. And the grades have gone up, or sorry, the recoveries have gone up. So again, we're getting more and more confidence. Our COO is a process engineer. So again, that's a big part of his background. It's one of the main reasons we wanted to bring him in. That's why we wanted him to take his time with this. It's also part of the reason why we want to start off with lower grade material in the first, 6-9 months, just to make sure we get that recipe right. But again, on paper, the recoveries have gone up.
And I believe it's the opposite for most of the mines. You trying to start with the higher grade ore first, but you mentioned this is gonna be like last 6 to 9 months. Like how confident you are on that?
Well, we have a historic stockpile that's in our published reserve and resource. That is 175,000 tons at 223 grams per ton. Now, again, that's good grade for a normal silver mine. It's not for our property, but it's good grade. And it's already been mined. It's already sitting on the surface, so you don't have to pay for the costs. So the margin on that is still even better than the grade might suggest. That 175,000 tons is about a third of 1 year's throughput, and that's already there. And we've been mining for about a year, getting the underground ready and pulling out ore. And that's higher grade ore. And we're kind of blending that with the lower grade material. So again, that's probably, we hope to have 6 months of that ready to go when we start the mill. So that's the low risk way to start up. It gives us time to continually develop the underground and have more stopes. So again, reduces risk significantly. It can reduce some of your capital requirements that come into your headline number. So that's the game plan. We'll use that material in the early days just to make sure everything's working correctly. And then when they are, that's when we'll put the high grade through just to make sure we get the most bang for the buck.
Thank you, Campbell.
Could you comment on, your market cap per ounce in the ground valuation and why it appears to be much higher than that of the peer group?
Sure. I mean, market cap per ounce is all related to margin per ounce. So I'll go back to gold here just to
And
make
I
it
just
an
want
easier
to
note.
jump in. Also, do you think you're getting any kind of discount doing gold equivalents, or is that muddying the analysis?
No, we can. I mean, we can do the gold equivalent here. I mean, if you go that middle column, you'll see, you know, most of the way down there, the average annual equivalent ounce produced. That's 180,000 ounces of gold based on the old economic study at $367 dollars to take it out of the ground. I think the average cost for the industry is about between 1,000 and maybe 1,200, 900 to 1,200. So when we talk about value per ounce, not all ounces are equal. If you had a $1,800 cost ounce at $1,900 gold, well, that's going to be worth a lot less than a $400 out of the ground ounce. So for us, capital efficiency and margin is a different dynamic. I could take this number at the bottom in the 135 million, or the one just to the right of that, the 737 million cumulative after-tax free cash flow. Again, that's at $19 silver at $14.50 gold. That's free cash flow. So again, when you look at other companies and you look at that free cash flow number, that's the best way to equate it to the value per ounce.
Okay, and someone noted that First Majestic is down the road. Any cooperation? Do you and Keith have a beer every once in a while?
Keith bought the property off of us. That's the one I was referring to that our CEO discovered, built, operated. That one was built with the idea in mind that half of the ore was reprocessed ore from the leach pad, half of it is fresh ore. The half of the ore that they're processing now from that leach pad is under 100 grams a ton. Again, our average is over 700. They have a new property called Ermitaño that they're working on. I hope they have some success there, but if they are, that ore is intended to fill that potential void if and when that material runs out. They have a 3,000 ton per day mill that we know intimately because we built it. You know, for us to have forego building the mill to truck our ore down the road and just throw it in the mill, we would increase the production profile dramatically. Again, you know, their average grade is significantly lower than ours. The risk would be lower. At the same time, we don't need to give away any value if it doesn't make sense to our shareholders. So yeah, if they wanted to pay a really big premium and our shareholders wanted that, that would be something we would consider. But again, we don't need a third party for us to get to cash flow, so it's nice to have that option.
Gotcha. And how many employees does SilverCrest have, and versus contractors, consultants?
Oh man, you're challenging my numbers here. I think, I mean, head office is pretty small, maybe like 12-ish. Down on site, we are contemplating having a third party work with us to build our mill on an EPC basis. And what that means is the engineering, procurement, construction. They give you a guaranteed price. If it costs more than that, they pay for it. So by definition, that project, if completed, would be fully based on contractors with us supervising. We are using Commodities as a contractor for the underground development. And then we would be doing our work for the power line and some of the COVID related stuff. So I don't know the exact numbers, but if I was to ballpark, you know, 80% contract workers might be in that range. We'll probably have about 500-ish employees at near the peak.
Okay. Thank you. Reached the top of our hour. I want to thank everyone for tuning in and for your great questions. And we'll be queuing you for feedback. It'll get to Chris and his team in short order. And you follow SilverCrest, follow AM EST Capital and the usual places online. And with that, Chris, a closing statement, remark. Maybe this is your, will you be publicly speaking again before next year, or is this it?
No, I think this is pretty much it. We're going to start to get a little bit too much information soon as it relates to the upcoming study, so we'll go quiet. But I think again the overarching view here is we've removed a lot of risk. There's still some more to come. We're still very much early in the growth phase. We hope to add a lot more ounces. The re-rate that typically comes with free cash flow is hopefully starting in the back half of 2022. We've been able to raise capital before, and again, impact to our share structure is quite negligible at this point in time. And if things don't go our way, meaning the industry, we should be one of the most defensive names out there. So again, I kind of say this as an investment vehicle, below average risk as far as mining companies go, and above average upside based on just continuing down the path we're on.
All right. Thank you. And have a great rest of the year, everyone. Take care.
Thanks so much, everybody.
Thanks.
Thank you.